All right. Thank you very much, David. I appreciate everybody being here today. This is a presentation that we have revamped for this year because we've got some 2023 information in here. You may have heard one of our presentations before, and we do have some additional information in here that might be of benefit. This is also the time of year when you're going to get hit smacked in the face with trading and taxation. So now is the time to start thinking about things. And so we're going to cover some of that. So you can actually, there's a few things you can do for 2022, but for 2023, you may have to apply some of this. But anyway, my name is Jerry Allison. I'm a CPA with Traders Accounting. And I'm doing all these tax returns and I'm helping clients, and we're doing the best to save them some money. So hopefully we can present some stuff here today that's beneficial to you too. Before we get going, I do want to present a disclaimer here, make the lawyers happy. To the best of our knowledge, this information is accurate as of the presentation date. I did make some changes this morning, nothing major, but I'm constantly reviewing this thing to make sure it's up to date. And tax changes do happen constantly. So prior to using this information, you should consult with your tax professional. And that brings up an interesting point. I was listening to Marina in the last presentation there at the end, and she made a statement. It doesn't matter what you think you know, and I'm paraphrasing here because there's a lot to it. It doesn't matter what you think you know, but your ego is not going to save you when things go wrong. And that's true with this stuff. You really need to find some tax professional that you can get some guidance on this stuff, because things do change and there's a lot of misinformation out on the internet. So please get a tax professional if you're going to use any of this stuff. The presentation does not present a professional or confidential relationship between you, me, or Traders Accounting. And Traders Accounting is not a law firm, and so the information provided here should not be construed as legal advice. Now, let me give you our contact information here. I'm also going to put this link right here into the chat. So if you'll give me just a second, oops, I'm going to go backwards there. We do have the website there. This is a special link that you can go to. And what it is, it's a link, and of course I'm not even there yet. So wait a minute, what's going on here? There we go. This link right here, it's a very special link. It actually goes back and gets you to an eBook. And what the eBook is, that you can use that for to download this eBook. It's got a lot of the information that I'm going to be presenting today, and I'm going to put that link in the chat right there because it is a complicated link, and that way you've got it right there in the chat. Now, we also have our phone numbers, 800-938-9513, and our email is learn@tradersaccounting.com. And I'm going to review this or bring this back up at the end of the presentation, so don't worry if you didn't get it at the moment. So let's go ahead and get into the nuts and bolts of this thing. Let's start with some basic information about trading. And a lot of our basis with the IRS of things, it comes from publication 550. If you want to download that from the IRS, you can just go to the IRS website, and in their search engine, put publication 550. You can download it to your computer. It has everything about investing, interest, dividends, bonds, options, and it talks about a lot of the stuff we're talking about. Not quite in the detail or the format that we have here. But one thing that is particularly true, that if you're serious about trading, you need to treat it like a business. The IRS is going to require that if you want to start deducting expenses, and if you want to do mark to market and some other things. And we'll go through all of this, but you have to be serious about it. Even if you are just trading and you don't really care about some of that stuff, you really need to think about your trading as a business. And the reasons for that, you need to be concerned about your cash flow. Every business should think about their cash flow. That's cash in as well as cash out. You all are taking training sessions. You all are going through this stuff. Marina presented a particular class that will help the income, your income coming in, how to trade better. And we get focused on the money coming in, but sometimes business people, particularly in traders, don't pay attention to the cash going out. How much are you paying for the training sessions? How much are you paying in taxes? How much are you paying for your subscriptions? Things like that. Are there ways to do things better? So you want to make sure that you're not only concentrating on getting money coming in, but also watch the money going out as well, and make sure everything pays for itself. Secondly, make the financial decisions based on business needs, not the tax code. This is actually, well, we're out of it now, but last month, December, is actually a very dangerous time of year for business owners, whether traders or not, because they start thinking, oh, I've got all this profit, so I need to go out and buy something in order to get a tax deduction. And that is very bad thinking right there. That will mess up your business and mess up your cash flow, quite frankly. Matter of fact, one example I had is I was doing accounting for a auto repair mechanic here about 20 years ago or so. And he came up to me in December and wanted to buy this tire repair machine. And he was going to spend $20,000 on it to get a $6,000 tax deduction. And I asked him, how often are you going to be using this tire machine? Oh, once or twice a year. That tire machine never would pay for itself. You do not need to be buying things that don't pay for themselves. Everything you do in the business and in your trading business should be making money for you directly or indirectly. So don't make financial decisions based on the tax code. It will mess things up considerably. Also, you need to be aware of all your tax and protection options. We're going to go through some of these. We can't go through every little nitty-gritty detail today, but we're going to hit a lot of them. And some of them we're going to be hitting. First of all, we're going to be talking about trader tax status. And this is for all traders. It doesn't matter who's trading. If you meet the qualifications, this will let you deduct expenses on your tax return. And by the way, this is still one of those things that still can be done for 2022 if you meet the qualifications. So if you meet the qualifications, feel free to get those expenses together, and we'll talk about that in a little bit. Then we're going to move into entities. A lot of people talk about, should I set up an entity for trading? We are going to talk about the reasons why or why not, and which ones are or are not good for traders. And then we're going to close out with a mark-to-market election. This is only for stocks and options traders. It only applies to them. So we're going to be looking at these things in that order. Now, let me go ahead and get on to trader tax status. Trader tax status is discussed in publication 550. And what this is a way for traders of anything to be able to deduct expenses on their tax return, whether it's a business tax return or a personal tax return. It can go either way, but it's a choice that you make. It's not an election or something you have to file with the IRS. So this can still be done for last year if you meet the criteria. Well, the criteria come from court cases. The publication 550 does not specify or give any definite criteria. Basically says you need to be treating it as if it's a job. You need to be devoted to it. You need to give consistent attention to it, which doesn't tell anybody anything. And so we have to rely on people going to court after the IRS has harassed them, and the court then makes a decision. So these are criteria that have come out of court cases. And so we know that if you meet these criteria, you're going to be okay. If you don't meet these criteria, it's very possible you might be okay, but you might have to take it to court. So it's a very gray area, and there's a lot of gray areas in this area. First one, you have to be making 700 trades in a year. Now, if you buy something and then you sell it, that's 2 trades right there. So most people who are doing day trading have no problem with that. Swing traders might get close to it. But this is the criteria coming out of a court. You need to be having this many trades in a year. Number two, there's trading in over 75% of the trading days per year. In other words, you have to put a good amount of the year into this to show you're actually running a business here. That's what the IRS is looking for. For example, if you owned a different a business like a restaurant or something, you don't operate for 1 month and take a month off. You need to be consistently doing that. And so the IRS is going to hold that standard to traders as well. So 75% of the trading days, you can take some time off, but not significant amounts. And you also have to put in 500 hours of trading, research, and education. Trading and research, we understand that. Education is what you're doing right now. You're attending this session, you've attended other sessions or will attend other sessions. That's all time that you can be adding up. I would suggest very strongly that you keep a log of what you're doing. The first two criteria here, you can justify that by giving an IRS examiner your 1099-B and your monthly statements from your broker. Bam, add them up and see what was going on, and just let them calculate that. The 500 hours, that's not provable on those statements. So it's probably a good idea for you to keep a log of what you're doing. Okay, now, here's an important point. The tax savings depend upon your current tax bracket. Most people, if they don't do it on their personal return, trade on their personal return, they trade in an entity, and most entities are pass-through entities, which means it comes right back to their personal return. It just comes back in a different way. And so if you are in the 37% tax bracket, every dollar you write off, you're going to save 37 cents. However, if you're in the 24% tax bracket, for every dollar you write off, you're only going to save 24 cents. And so, it depends on, if you're in the higher tax bracket, this becomes more and more important for you to do. Now, I do have a warning here, because we're going to talk about LLCs in a little bit, but I want to talk about this warning as far as individual investors, people who invest on their own personal tax return. If you do trader tax status and deduct expenses, then what's going to happen is you're going to deduct those expenses on the personal tax return using a Schedule C. Now, you can go to the IRS and look up a Schedule C. It's a very common form. It attaches to your personal return. It's basically a small business return. And what you'll find is that at the top of that, there's income, and at the bottom there, you can list expenses on there. For traders, your income doesn't go on a Schedule C, it goes on a Schedule D. But the expenses go on that Schedule C. Okay, so there's no income, you've got just expenses on that Schedule C, which means technically you have a net loss on the Schedule C. That creates some problems here. Here's one. Number one, your audit risk is increased. There's two things that happen here. One, the Schedule C is almost automatically, well, I don't say automatically looked at by the IRS, but it is something, it's the most commonly looked at item over everything. Corporations, partnerships, everything. That Schedule C is the most likely to get audited. And the reason for that, you are putting on numbers there that they can't verify. You put $15,000 in subscriptions down there, they can't verify that. So if it looks strange to them, or they just decide they don't like your return, they're going to come and ask you, okay, prove that. And you might say that, well, I can prove that, but do you have time to prove it? This is another thing that happens. A lot of people think, well, I can handle an audit. Well, do you have 10 to 20 hours to take out to do that? Time is money. That's one possibility if you do this on your personal tax return. Second of all, there's no home office deduction. Now, if you read out there, oh yeah, there's a home office deduction for a Schedule C. There is, except if you go down and you look at that line below the expenses and on the Schedule C, there's a line for home office deductions, a very special place. And if you go back to the form where you fill out the home office deduction, which is a separate form, you'll find out that once you calculate your home office deduction, if you have a loss or net negative profit or net loss on the Schedule C, then you have to take the home office deduction and defer it to next year. So if you have a loss on your Schedule C, you can't take the home office deduction this year. It gets deferred. Well, for traders, you never, ever have a profit because it's only expenses. And so that home office deduction gets deferred later and later and later. Now, you may see out there on the internet, some people say, well, let's just take some of the income and move it from Schedule D into Schedule C. And that, I think, is extremely problematic. It's like if you have a W-2 job and you just decide, well, I'm not going to put it in the W-2 category. I'm going to put it into long-term capital gains and just get a 20% rate on it. It ain't going to work. The IRS is going to have a cow over that if they find it. So really, technically, no home office deduction. Now, there's something beneficial here in a little bit. We'll talk about that. There may be no asset protection. Now, if you trade as an individual, and you get sued, let's say you have a car accident and your insurance is not enough, or something happens, somebody gets injured on your property or whatever, and the insurance is not enough, then they can go after your assets. Now your trading assets are possibly at risk. Now there are trusts and other things that you can use. That's why I said there may be no asset protection, but trading as an individual can be extremely risky in that respect. Number 4, there is a problem with the IRS. If you have a W-2 job and you're an active trader, for whatever reason, the IRS doesn't like that. They don't think that you can do a full-time W-2 job and be a full-time trader at the same time. Now, this is for one person. You can say, well, my wife has a job and I'm trading, so that's not a problem. It's when you, whether male or female, you have the W-2 job and you are the full-time trader. That begins to be a problem. So be aware of all 4 of those problems there that occur if you're trading on your personal tax return. So having said that, trader tax status, you can write off expenses on your tax return if you meet the criteria. If you're going to do it as an individual, you can do it on Schedule C. And personally, if you're going to do it for 1 year, I don't think it's too risky. You just go ahead and do it and get it done. But the solution to some of these problems right here is actually this, has to do with entities. So this is why we're going to dovetail into talking about entities. There's several types of entities. You have sole proprietorship, single member LLC, general partnerships, limited partnerships, multi-member LLCs, S corporations, LLC S corporations, C corporations, and LLC C corporations. That's a lot of stuff, and we're going to weed some of this stuff out right now. A sole proprietorship is what I was just talking about, is trading as an individual on your personal tax return. You're deducting those expenses on the Schedule C. That's what a sole proprietorship is. And quite frankly, that creates all kinds of problems. But a single member LLC does exactly the same thing. It puts it right back on your personal tax return on that Schedule C. So it doesn't do anything for you except maybe give you some asset protection. But it doesn't solve that audit risk problem. It doesn't solve the W-2 conflict with trading, etc. So for traders, on traders only, single member LLCs do not do anything for you. Now, that leaves a bunch of other stuff, basically partnerships, S corporations, and C corporations. The type of entity that's right for you depends upon your situation, which is why we go back to, you really need to talk to a tax professional and get some guidance. I'm going to give you what we do and what we talk about with our clients at Traders Accounting, but you really need to talk to somebody to make sure this is right for you and develop a plan for the future as well. Now, generally speaking, we at Traders Accounting recommend a multi-member LLC. Now, that is a partnership. Quite frankly, it defaults to a partnership. But we're going to talk about why we recommend that. Now, before I talk about the pros of it, the cons are 2 things. You do have a yearly multi-member LLC fee with your state. Generally, there's a handful of states that once you set up the LLC, you don't have to pay for it anymore. That's Arizona is one of those. But generally speaking, most states have a yearly fee to keep registered, and you're going to have a tax prep fee. The reason for the tax prep fee is we have to get this off of your personal tax return, because if it stays on your personal tax return, that Schedule C, you increase audit risk and all the other problems that are associated with it. So we need a partnership return, or we need an S Corp return, or possibly a C Corp return. All of those are separate returns, so you're going to have an extra tax prep fee. Those are the cons. Now let's talk about the pros of a multi-member LLC. First of all, an LLC, including a single member LLC, will give you asset protection. What happens in the LLC stays within the LLC. What happens outside the LLC stays outside. Now, that depends upon which state you're in also. Every state has different LLC protections, so you're going to want to probably talk to an LLC attorney in your state to find out the exact thing that you have. We design this thing so that you do have some asset protection. You do have a choice in taxation methods, and this is something that's absolutely critical right here. If you have an LLC, a multi-member LLC, let's say, you have a choice at the beginning of being taxed as a partnership, an S Corp, or a C Corp. You can choose. IRS doesn't care as long as you file it within a certain amount of time. And every year you can file with the IRS and say, I want to be taxed this other way. Generally, the default way is a partnership, and that's how we start off for particular reasons, because you really need to actually build things up and get that base started. But later on, if you want to go the S corporation route, we file an election with the IRS to be treated like an S corporation. That has certain benefits. You can be treated like a C corporation. That has some benefits, but they also have some liability. So again, you need to talk to a tax professional. Number three, a reduction in IRS scrutiny. What we have seen is the IRS really tends to look at individual taxpayers and light items there. They really don't as much examine off return, what I'm calling off individual returns like partnerships, S corporations, and that as much, unless there's a glaring problem. I saw an article the other day from Syracuse University. Now, if you remember back when all the hoopla was the Congress passed the funding for the 87,000 new IRS agents. And of course, people were going berserk, and the IRS came out and said, you know, these agents are not going to audit individual taxpayers. They're going to go after big corporations and rich taxpayers and all that stuff, because we need all that extra stuff. And I started telling my clients at that point, said that's not true, because they're going to go after the low-hanging fruit. Why would they bottle up, let's say, 50 auditors going after this huge corporation? And all of it's going to get tied up for years, when you could take one auditor and you can go after an individual taxpayer and maybe soak a couple $1,000s out of them. The reason is these big corporations, people who are making tons of money, have lawyers and can afford to bottle this thing up for years. Most normal taxpayers, where the money is, quite frankly, can't do that. And so they're going to settle. And the reason I'm saying that now is because I read this article about a study done by Syracuse University recently, and they examined who the IRS was auditing. They're not going after big corporations. They're not going after rich people. They are going after the smaller taxpayer who cannot defend themselves, who is more likely to settle. And that will take maybe an hour of an IRS examiner's time, get a couple $1,000s out of them, move on to the next one. It's much more, I hate to say it, it's much more business efficient and raises a whole lot more revenue than tying a bunch of people up for several years trying to get a couple $1 million out of a company. So getting the IRS view off your personal return is extremely critical. Number four, that home office deduction that I talked about a little bit ago, that comes back to you. See, the only limitation to that is on the Schedule C. And if we get rid of that Schedule C, For a multi-member LLC, you get to do that again. So you get this deduction. The IRS just will pay a simple $5 per square foot up to 300 square feet. So a maximum of $1,500 if you use the simplified method. If you want to itemize your deductions, you can take the percentage of your square footage of your office versus your home or apartment and write off a percentage of your mortgage interest, your real estate taxes, your rent if you rent, utilities, insurance, all this stuff that goes into that. And you get that again. In most cases with people, I found we can get at least $1,500 to $2,000 in home office deduction. Now hang on to that number for a minute. Number 5, getting this trading business off of your personal tax return onto, say, a partnership return, which is a multi-member LLC default, it solves that W-2 trading issue. You don't have that anymore because the IRS now looks at, you've got a W-2 on your personal return, and now the partnership is a pass-through entity. It still passes everything back to your personal return. However, it goes on the Schedule E, and it looks like you're investing in this business. So now you have a W-2 job and you have an investment. It solves that problem that you had. The other problem it has, it really makes your personal return much more concrete, because now your W-2 has been reported to the IRS, so they know you can't fudge that. The partnership gets reported to the IRS. And so when you put those K1s, which you get from the partnership, and you put the numbers on your personal return, that's already been reported to the IRS. So they're not going to dispute the numbers on your return unless they disagree with the numbers that the IRS already has. So what I'm saying here is you've got stuff that's already been validated with the IRS on your return if you move it off your return. So your personal return becomes much more ironclad. Number 6. Now we'll get to this in a little bit. It solves the mark-to-market long-term, short-term dilemma. And let me explain what that is really briefly. With mark-to-market, for you stocks and options traders, you do not want to put long-term assets under mark-to-market, or you lose the long-term capital gains rate, the maximum of 20%. You don't want to do that. You got stock that's appreciated $20,000, $30,000. You don't want to be paying tax on that appreciation every year. And you lose that 20%. You want to wait until you sell it 5, 10 years down the road. And then whatever your gain, the maximum you can pay right now is 20% on that. So what we do is we tell our clients, keep your long-term assets on your personal side and put the short-term day trading or swing trading securities, put that on the business side, the multi-member LLC side. And that way they're separated as far as they can be. The mark-to-market is on, the election is on the business side, the LLC side, but on your personal side, there's no mark-to-market where you can keep the long-term stuff. And so it just breaks everything apart so the IRS doesn't really look at it. Now, I know some of you are asking some questions, and I'm going to pause right here before I go to point number 7. 700 trades open and close combined? No. I think I mentioned this, that if you buy something, that's one trade. If you go sell it the same day, that's another trade. So that's 2 trades right there. Even lots, if you start thinking about lots, every lot is a different trade. So that's very important, because it's easy to get to that 700 trades. Next question, how do you plan for a multi-member LLC if you're single? We have a lot of people like that. One, you could get a family member, another family member, who owns 1% and you own 99% of the multi-member LLC. That's one possibility. 2, we could set up what we call a family trust. It's an irrevocable trust that gets 1% of the profits, and you still take 99%. Now that's on paper. You do not have to actually put it in the trust until you pass away. And of course, at that point, you really don't care anymore anyway. So the trust is basically a paper owner. So now you've got your other partner. There are other complex things. We could set up a single member LLC that could be your second partner in a multi-member LLC. That gets a little more complex. For those of you who have already maybe a C corporation, an S corporation, or another partnership, or even a single member LLC already, those can be your second partner. So that works out. There's a lot of ways to do this, but that goes to the next question here. Husband and wife filing joint. Yes, we have a lot of husband and wife teams that actually become a partnership. So the husband owns part of it, the wife owns part of it, and one of them does the trading. We have some wives that do the trading and the husband doesn't do anything. And so some that where the husband does a lot of trading, the wife doesn't do anything. The other person is just a placeholder. So there's a lot of different options to get this thing done. All right, let me go now to point number 7 here on this one, because this one is actually brand new. We have looked at this for the at the end of last year, and it's something that's actually astounding. The tax savings that you make on the multi-member LLC can pay for it. Now, remember what I said up here at the top of this slide. The cons are you've got a yearly multi-member LLC fee and a tax prep fee. How would you like the government to pay for that? Through refunds, and we could get the refunds enough to do that. Let me give you an example so I can show you what I'm talking about. The idea here is if you already have yearly trading expenses, the refund you get from deducting those expenses could pay for the yearly multi-member LLC fee. Now, it doesn't matter whether you go S Corp or C Corp or partnership, same thing, and the tax prep fee. You can get enough. Remember what I said a little bit ago about home office deduction, and hang on to that number. A lot of people get $1,500 to $2,000 back just for their home office deduction. In a lot of cases, and that's the deduction you pick up by going to the multi-member LLC. A lot of times that's enough to give you a refund enough to pay for the LLC. For example, let's assume a person lives in Oregon. Now, let me stop here. These numbers depend upon the state you're in. It depends upon the LLC, yearly LLC. It depends upon your tax prep fee. It depends upon your tax bracket. So I'm just giving one example here. But let's suppose the person lives in Oregon. Now, I looked this up this morning. The LLC fee in Oregon is $100 per year. And let's suppose your tax prep fee is $750 per year. So you have a total of $850 in extra expenses. Now, all the other expenses you might want to deduct on your Schedule C. These are the extra expenses for just having the LLC. I want my partnership or my LLC to pay for that $850. All right, let's make some other assumption. Assume the person's in the 32% federal tax bracket and the 8.75% Oregon tax bracket. So you have a total bracket of 40.75%. So we would like to get enough in expenses to actually get a refund of $850 so that the LLC is free. And that's exactly what we're after. I've calculated this. This person needs at least $1,236 in trading expenses to get the government in refunds to pay for the LLC. Remember what I said about home office deduction, that we can generally get $1,500 to $2,000 just out of your home office? Ding, 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 ding. That alone, picking up that deduction on the multi-member LLC will be enough to pay for the LLC each year. Now, you want me to prove it? Let's go ahead and go through that. Here's the proof. Now let's recall our trader has $850 in LLC expenses. That's the yearly fee, that's the tax prep fee. Those are the extra 2 expenses that you have by having an LLC. And let's put the taxpayer is in the 40.75% tax bracket, federal and Oregon combined. And I calculated that there's $1,236 in trading expenses. The more expenses that you would deduct, the better, and the refund would pay for it. So let's just suppose they've got $1,236 in expenses they're going to write out. These are extra expenses, not the $850 in LLC expenses. They're extra expenses. So it could be home office deduction, Could be subscriptions, could be training seminars, things like that. Anything, any expense that you have in trading. Most traders have that number easily. Now, let's look at the proof here. Total deductible expenses, you got the $850 that you have in extra expenses, and the $1,236 that you have in normal trading expenses you would have. So a total of $2,086. What we're going to do, that $2,086 goes on the tax return, and it's going to get deducted at the tax rate. So if you take the $2,086 in expenses and you multiply it by the tax rate, you get $850 in refund. That's the exact amount of your LLC fee plus your tax prep fee. So all you need is $1,236 in this case to get the LLC to pay for itself, get the government to pay for it, basically. Now, think about the expenses you got. What did you pay to attend the seminar today? Again, I was listening to Marina in the prior session. If you subscribe to that, that's an expense. Again, your home office deduction, any data feeds you've got, your computer can be written off. The home office, or your furniture in your home office, can be written off. Margin interest, if you use margin interest, that's a huge amount a lot of times. $1,200 is nothing to come up with. So I'm telling you, it's often very profitable for you to get your LLC set up, a multi-member LLC, and it will pay for itself in the long run, quite frankly. All right, there's enough of that, something for you to chew on. Now, the trader tax status, that's expenses on your tax return. We talked about LLCs. We generally recommend a multi-member LLC because you have a lot of flexibility and taxing. You have a lot of ways of taking care of things, and you certainly can get the government to pay for it. All of that stuff, those two prior things, anybody can do. Anybody. If they're trading, as long as they meet those criteria, not a problem. Now let's move on to the mark-to-market election. This is only for stocks and options traders, which probably most, if not all of you are. This is an election that can be made not by you personally, or it can also be made by a business entity. So however it's done, wherever the trading assets are, that this election can be made. However, it is an election, so it has to be filed with the IRS, and we'll talk about that in a little bit. But you also, if you do it on the individual side, you have to meet those trader tax status qualifications. That's one of the reasons I led with that, is you have to meet those. If you lose those qualifications, in other words, you don't have 700 trades a year, or you don't trade 75% of the trading days per year, you're going to lose mark-to-market as well. So it's very important on the personal side to keep those qualifications up. Whether you have to keep them up on the entity side with the LLCs, that's a little vague. So some people say you have to keep those qualifications up just in case. Some people say, no, you don't, because the IRS doesn't look at it that much. That's something you have to decide. Now, for those of you who trade stocks and options, you know that there's a couple problems, and one of those is wash sales. If you sell something at a loss under a ticker symbol, it doesn't matter about the option or whether it's a stock, whatever. If it's under that ticker symbol and you sell it at a loss, and then you buy anything under that ticker symbol, stock, different, or option with a different strike price, different expiration date, it doesn't matter. As if you buy something within 30 days, then that loss on the first sale moves to the second sale. Now, that doesn't sound like a lot, but what happens when you're doing a lot of trading, those losses can move forward and have a tendency to cross over December 31st. And so you have a group of losses that cross over December 31st, or in other words, those wash sale losses, you're going to end up paying taxes in 2022 and hoping to get that money back in 2023. Now, one sinister thing about that, you say, well, I'm going to get it back anyway. Well, there's the time value of money where you could really use the money now to invest. But wash sale losses, when you pay tax now, generally you pay in a higher tax bracket. When you get those losses back, you get to deduct them in a lower tax bracket. So it ends up the IRS wins on that one. Well, the mark-to-market election eliminates wash sale losses. You don't have to worry about them anymore. Now, it's not just as simple as taking your 1099-B and just adding back the wash sale losses. It's not that simple. I'll talk about it in a little bit as to how, but you don't have to worry about wash sale losses anymore. The second thing it does, it eliminates the $3,000 loss deduction limitation. Let me explain this. Under normal accounting, if you take all your gains and losses for a year and add them together so that you have a net loss. For example, if I'm trading throughout 2022, and let's suppose when everything's added together, I actually lost $20,000. Under normal accounting rules, I can only take $3,000 of that on my tax return and have to carry the remaining $17,000 forward to next year. And if I don't have any gains next year to offset those $17,000 of losses, I get another $3,000. I carry the remaining $14,000 over. So it becomes problematic. You're not going to get that $3,000 or that $20,000 back right away. Additionally, it creates all kinds of problems. But as I said a little bit ago, remember this: when you end up paying tax on that $17,000 that you couldn't use in the year. Remember, when you pay tax, you do it on a higher tax bracket, but when you take losses, generally that's in a lower tax bracket. So you end up feeding the IRS anyway. So the mark-to-market election eliminates the $3,000 loss limitation. If you lose $20,000 in a year, you get to write $20,000 off. And I've seen people under mark-to-market write off $50,000, $100,000, $250,000 in a year. And if you use, and that goes against W-2 income, it goes against 1099-R pension income, things like that. And if you have loss left over, it carries forward to next year to offset any other income there. So it really is a great thing for traders of stocks and options. If you meet the TTS requirement, I suggest wholeheartedly that you make the mark-to-market election. Now, how do you do that? Well, this is an election with the IRS. You have to let them know you're going to do it. And so you have to do this at the beginning of the year, and now is the time to do it for 2023. So if you want to make the mark-to-market election, you actually have to file, it's not a form. People get that confused all the time. You just have to kind of write a letter to the IRS or put something with your tax return. But you have to do it as an individual. You have to do it by April 15th of this year. Once we get to April 16th, you cannot do it anymore. Or if the tax returns are due on the 17th, you could do it to the 17th. But once the tax deadline goes by, you can't do it anymore. And there's no extensions to this. The publication 550 is very adamant about that. It has to be done by April 15th. For entities, existing entities, it has to be done by March 15th, with one exception. A brand new entity, you can elect it immediately. So for example, let's suppose today we started a multi-member LLC. We can elect mark-to-market right now. We could. Or if we wait till September and form a multi-member LLC, we can elect mark-to-market as soon as that thing is formed. Now, technically, we officially put that in our records, but the election doesn't have to be made until the first tax return. This is the one time that mark-to-market is retroactive. So let me emphasize that there's only one time it's retroactive with the brand new entity. You can file it with first tax return. You cannot, there is no way you can make a mark-to-market election now for 2022. It won't work. And I have people call me up almost every week, usually 2 or 3 times a week, wanting to do this, and it cannot be done. Publication 550 is very adamant about that. So if you want to make this election, and you want to do it yourself, then publication 550 tells exactly what you need to put in that letter. If you want Traders Accounting to do it, if we do your tax return, we'll put it right with the tax return and make sure it gets done. We'll make sure it's done by April 15th, but it has to be done by then. Or you can do it for an entity as well. So now we've covered mark-to-market. which is for stocks and options traders, that really gets around the wash sale losses and that $3,000 loss limitation. In other words, there's no more deferred losses. You pay tax exactly on what you did. And quite frankly, I didn't mention this, but when the mark to market, when you look at that for tax purposes, you take what the account was worth at the beginning of the year and what it was worth at the end of the year and subtract them. If your account goes up, that's what you pay tax on. If your account goes down, you get to write all that off. Really, that's the simplistic way of looking at it. Now, someone may be thinking, well, what about if I take money in or put money in or take money out or other stuff? That has to be accounted for too. But if you just put, like, say, $10,000 in to an account, and at the end of the year, it's $13,000, and you don't put anything in, you don't take anything out, you have a $3,000 gain, period. There's none of this wash sale stuff going on. So it's really a pure way of paying taxes on what you actually made. That's really nice. So we've talked about mark to market. We talked about trader tax status, which is a requirement that you meet those criteria before making mark to market. And so trader tax status is deducting expenses. And then we talked about entities. Entities are great for getting around the IRS scrutiny. They also protect your assets, and they eliminate a whole bunch of problems, not to mention we can get the government to pay for it in expenses you're probably already going to deduct. So in summary, again, trader tax status allows you to deduct the trading expenses. Forming an LLC provides asset protection, decreased audit scrutiny, and it could be free. And your mark-to-market election allows stocks and options traders to pay tax on what was really earned or write off entirely what was lost. So let me go back to our slide, our contact information. And and in this case, before I turn it back over, our contact information here, we have this website link. I'm going to put this into the chat one more time, so that everybody's got it there. You can copy it and you can go and you can download a free ebook. You do not have to, no obligation here. You can download it to a computer. Matter of fact, last presentation I had, it was a different link, but I had people doing it while I was talking about it. So feel free to go do that and download that ebook. Our phone number is 800-938-9513. If you want to call us for a consultation to find out what's right for you, certainly do that. Our administrative assistant, Crystal, she'll answer the phone. She can get you all set up. If you want us to do your tax return, or if you want bookkeeping services, or if you just need us to set up an entity, we do that as well. We can set up the trust. We can set up any state's LLC that you want. So we can do all that. We can handle a whole ball of wax. And then, of course, you can email us if you have any questions. So let me go ahead and turn to the chat now. Certainly, if you've got any questions here that need to be answered, we just had one pop up. And another one, do entities need to be set up before the brokerage accounts for active day trading activities are opened and utilized? Great question. And that gets into some of the details that we have to talk about. Is when you form an entity, you're going to have to form a brand new trading account. Because what happens when you form an entity like a multi-member LLC, you get or need to get an EIN, an employer identification number from the IRS. That's like the business's social security number. And then new trading accounts have to be set up under that, because the IRS, if you trade under your personal account, that's where it's going to have to be reported on your personal side. Remember, we talked about getting that off your personal tax return. So if your trading accounts are under your personal social security number, that's going on your personal account, period. Personal tax return. So you have to set it up under the business side. That is one of the caveats here. There's a little bit of work that has to be done. So you would have to open up new brokerage accounts and then start trading. Keep in mind, the LLC starts the day it's formed in the state. And so, and you have to start up new trading accounts. You can't take it backwards. There's no way you can go backwards. So your trading right now is under your personal accounts. So you start an LLC right now, we can get it to start, let's say at the end of January, beginning of February. But right now you're trading under your personal account. So you have some of those issues still going on. Next question on wash sales, does it matter in an IRA or 401k account versus a taxable account? Actually, IRAs and 401ks are completely separate as far as pensions. This stuff does not apply. You don't have wash sales in an IRA or in a 401k. Now, that's another problem actually that brings up here, and I didn't go into this. It is possible that when you're trading in an IRA or 401k and you've got personal trading accounts, money, your own money accounts, if you want to call it cash accounts, some people call it, outside of that, you can create wash sales by what you do in the IRA. The wash sales not in the IRA or the 401k, but they can be created in your personal trading account. And so there's issues there that those are linked together. That's another reason for forming an entity is you keep your IRAs and your 401ks on your personal side. You can't do anything with them anyway. You trade in them, but if you've got cash accounts, get them into a multi-member LLC, and then you don't have that wash sale stuff going on. Okay, hopefully it answered that. Buy right index taxed. It depends on about as far as indices. It depends on what's showing up on your statement. If you've got two different transactions there, that's going to be two different trades. A lot of this is how your broker, and if your broker is going to record it under normal accounting rules. And so that's actually kind of a question for them. However, if you go mark to market, then this stuff doesn't matter at all because you don't care about individual trades. It's just your market valuation at the beginning, market valuation at the end. You don't care about individual trades. It doesn't matter what happened in the middle, except for accounting for contributions and stuff like that. Any suggestion on how singles can form a multi-member LLC? Yeah, I'll go back through it again. One, you could find a family member that's willing to take, let's say, 1% of the profits. And really the tax implications are minimal to them if you can do that. You can also set up a family trust. The beneficiary could be anybody in your family. You could have nieces, nephews, your own kids, or even anybody really in your family. You could set up a trust that would be 1%. And again, this is paper. So the money doesn't actually have to be paid into the trust. You can keep it all in the trading and keep building that up. It's just when you pass away, the trust then gets 1% of all the earnings they've earned. There are other complicated ways of doing it. You could have a single member LLC and a multi-member LLC. And the single member LLC could be a partner with you in the multi-member LLC. That's how it can get done. Other people have already businesses like single member LLCs or other multi-member LLCs, S Corps, C Corps, things like that. Those can be the second partner. So there's a lot of ways to get it done. And we've helped a lot of single people actually form multi-member LLCs. And I've used the first three, and usually that's enough. The partner, the family member, or the trust, or the additional single member LLC. All of those work really well. Wash sales do not exist. Okay, next sales, wash sales not tracked on crypto. Wash sales do not exist for crypto at this point. So when you're talking about mark to market, there's a belief that crypto could be applied to mark to market, or mark to market could be applied to crypto. But there's no wash sale, so it loses that benefit there. So the only reason for putting crypto into mark to market is for the loss protection. It gets around that $3,000 loss limitation. Now, I suspect that if Congress or the Treasury Department ever gets their hands on crypto and starts defining some things, they may want to treat crypto like stocks and options. But as of right now, it's just straight gain or loss, no wash sales. Okay, any other questions before I turn this back over to our hosts here? Anybody? We'll wait a few seconds. All right, well, I'm going to stop sharing my screen right now. And then, David, are you back